la famille.
So right now we're going to switch and I'm going to welcome Matthias. Matthias, who used to be an entrepreneur as well. He's a director at the family, very at ease in financing environment. How are you, Matthias?
I'm good. Can you hear and see me?
Perfectly well. The sound is perfect. The image is perfect.
Excellent.
The haircut is perfect.
Yeah, I was going to say, you're going to see on the first slide that there's a big difference between my hair when hairdressers are open and when I cut my hair myself.
Oh my God. One of the impact of COVID. Okay, maybe the people you can relax a little bit. I know it's been long. It's the third part. It's an important one. We're going down to the concrete stage. So break down a little bit before switching to the slide. It's going to be intense with Matthias. I'm telling you, he speaks fast, very fast. So feel free to ask all of your questions in the chat and we'll try to answer as well. All right. See you in 20 minutes.
Yeah.
Good luck.
Thanks a lot, Alice. So hey, everyone. I'm also going to try and make the most of speaking in front of the screen. I know that it's not always a easy exercise for me and for the audience, but we'll get there. And I promise I'll make my best effort to not speak too fast. If there's something you don't understand because I'm speaking too fast or I'm using jargon, please feel free to ask questions in the comment section, and I'll make sure to get to them at the end. Cool. So with Usama and Baltazar, we sort of discussed what happens as you're preparing for your first meetings with investors and how you decide when, how much, and from whom you should raise. And now we're going to get into some of the more practical stuff. And so we're going to talk about how you pick who to reach out to, how you actually reach out to those people, and what the first few encounters look like. So one thing that was sort of briefly touched upon actually, before we get there, I want to put a word of caution. So why am I putting a word of caution? We've been talking about fundraising like it's some sort of like easy exercise. And I know that Baltazar and Usama have emphasized that it's not easy, but I just want to repeat it once again. Like, fundraising often takes more time than you think. It always takes a lot more energy than you think. And it's probably a lot less stimulating than you'd hope. So you end up repeating a lot of the same thing. You end up being quite disillusioned. I think regardless of the quality of the founders, often they'll end up being a bit disillusioned with the amount of work that the VCs do for their first meetings. And you'll see that even though obviously it's not something that's great, it's something that's sort of understandable when you understand what the incentives of the VCs are and how it's, what's actually the optimal behavior on their part from an economic point of view. And we'll get into that in just a bit. So without further ado, here's what we're going to be talking about. So when does the fundraising properly start? Who do you talk to? How do you reach out to those people? What does this first conversation look like? So one of the things that Usama and Baltazar mentioned is that you should either be in fundraising on mode or off mode. If you're just spending a lot of time speaking to investors when you're not fundraising, you might be losing some time. I think that's definitely true, and in the sense that in the early days, you should be focused on building your product and speaking to users and selling that product to your users. But it's still very valuable from the moments that you realize that you are going to need to fundraise at some point to start entertaining some form of relationships with investors. And there's several reasons why that's useful. One is that it creates some form of momentum. So if you're speaking to investors every 2 months and giving them a quick update on the business, asking them a few questions, it's going to allow you to do several things. First, it's going to give them the impression that you're progressing. If you think about it, the investor is trying to draw a curve of what your business could look like, right? They're saying, okay, this is where they're at on month 1, this is where they're at on month 3, month 5, month 9, etc. And they want to know if that curve is going to continue going up and up and up and to the right. If you just show up one random day and you say, hey, we're fundraising, all you're giving them is 1 point. So they're trying to draw a curve from 1 point. it's a lot easier to draw a curve if you have several points than if you only have one. And so if you've been maintaining those relationships for several months, obviously they'll know that you're hiring people and potentially better people, that your revenue is going up, that the size of your customers is going up, that you're releasing new features, et cetera, et cetera. And so when you say, okay, we're actually now looking for money, they'll be a lot more likely to invest. The other thing is that it'll give you the opportunity to sort of test what your relationship is like. Your relationship with an early stage investor is a relationship that's going to last probably between 5 and 7 years. You won't be working with them day to day, but you'll be working with them every quarter. And when you've raised your first round, usually the lead investor, and we'll get to what that means, the lead investor of your first round is very active in helping you raise the following round. And then the following investor helps you raise the following round, et cetera, et cetera. But so regardless, it's very important to have a strong relationship with those people. And so if you've had some time before that to work with them or to get their feedback or just to update them on the business, you'll know as well if you are happy working with them. And so obviously, especially if this is the first time that you're building a company, it won't be super easy to know who you should be reaching out to. But fortunately, fortunately or unfortunately, the amount of people you can reach out to is actually quite small. So I think there are two types of people that you should be thinking about when you're not yet fundraising, but thinking that you'll be fundraising in the next 6 to 12 months. And the two types of people you should be thinking about are, one, angel investors that are industry experts. So when I say industry, I don't necessarily mean people who are working in the exact same vertical. So typically, I don't know, if you're a company that's making it easier to buy shares in buildings, so like you're technically a real estate company, but that you're targeting retail investors and you want to have a super slick investor experience, then maybe you need some people who are really good with product and design, right? And so you should be speaking to some real estate people, but also to some product and design people. And one of the great things about the tech industry is that a lot of the people who invest also spend a lot of time writing content or doing events like the one that we're doing right now. And so by going on places like Twitter, it's quite easy to find out the people who are relevant in your field, and then just reaching out to them. If you produce interesting content, they might even reach out to you. So that's the first type of people I think you should be reaching out to: angel investors who are industry experts or who have some form of expertise that's very relevant to the product you're building or the audience you're targeting. The second type of people that you should be reaching out to are local early stage investors, so usually local seed funds. And the reason why you should be reaching out to those is that their job, so like the job, especially of the junior people, is to make sure they don't miss a single deal in the region. And so if you send a nice, proper, informative cold email to them describing what you're building, where you're currently at, what your needs are, what your questions are, more often than not, they'll respond, and more often than not, they'll take a quick call with you. And then if the call goes well, then you can have these sort of regular catch-ups with them. And the reason it's a good idea to go to those isn't necessarily that that local seed fund is the best investor for your actual round. But there are two reasons. One is that on a cultural level, they might be one of the best fits. And the second is that usually these local seed funds are connected to higher quality funds in different regions. And so if they end up being interested in your round and you find a way for them to participate, they might help you reach out to those better funds outside. So that's when it comes to building that list. One slight thing on the early stage funds is that sometimes it can be interesting to speak to portfolio companies of those funds. So it's quite easy because the funds have their portfolio companies easily accessible. So you can just go on their websites, look at the portfolio companies. And if you reach out to the founders asking for just an introduction or a 10-minute call to get a reference on a fund, usually they'll do it if they're happy with the fund, or if they're not happy, they'll probably do it either way. And that way you can get some feedback and you can get a warm introduction. And we'll see that in some cases, some funds much prefer warm introductions. Okay, so building your list of targets. So now that you've decided that you needed to raise, you want to know, so you know how you want to raise, you know that the time is now, you have an idea of how much you're going to ask and at what price, then the question is, okay, who are you going to raise from? One of the things that's very important to understand, and I think that we've been repeating this quite a bit, is that what drives a venture round is mostly momentum and FOMO, and we'll get to FOMO later. But what I mean by momentum is that you need to give the impression to the potential investors that your round is progressing, right? And that every week the business is growing, and that there's good news coming from the business, but also that there's more and more pressure from the market to invest in your business. Until they feel that that pressure is high enough, they won't necessarily feel compelled to build it. And so what's very important is that they need to have the impression that you're speaking to a lot of people. And so who should you include in that list? So the people that are going to be able to make the quickest decisions are angel investors, for the very simple reason that they invest their own money. So even though if you're raising a round that's north of €1 million or $1 million, you probably won't be raising solely from angel investors, though it's becoming increasingly common to have rounds of that size that are done solely by angel investors. But presumably there will be some funds involved. Even though those angels won't be taking the majority of the round, it's very important that you take them, that you have some conversations with them for several reasons. The first one is because they signed those first checks. It means that whilst you're having the discussions with the funds, you'll do one meeting and then 10 days later you have another meeting with the fund. If in between those meetings you can say angel investor A, B, and C invested, that there's momentum, right? Because they'll be thinking, if these angels are investing, then it means that funds might also be interested, and so I need to get to work quickly or else I'm going to lose this deal. So on one side, you need to have this list of angel investors. Angel investors, again, sort of like funds, you'll have a mix of people who are industry specialists. So if you're a fintech company, you'll see that there are dozens of people who only invest in fintech businesses. So the idea is to reach out to them. If you can find somebody who's raised money from those people who can introduce you, that's even better. But even reaching out cold is fine. If you're sending an investment opportunity that's relevant to them, again, more likely than not, they'll respond. So industry specialists, then you have sort of general super angels, so people who do dozens of tickets every year. They're always worth reaching out to. And then you have sort of local angels who are sort of generalists but invest solely in the region. And you have quite a few of those. Usually they're the local angel superstars because they've exited their business or something. So that's for the angel investors. Then for the seed investors, one of the big questions is, okay, I'm a small company in Romania. Should I be speaking to Sequoia? Well, even though the probability that a fund like Sequoia invests in a seed round of a Romanian company is quite small, it doesn't mean that you shouldn't be speaking to any funds outside of Romania, right? There's a spectrum. And it's actually very important that you speak to as many funds as possible that are reachable, not so much in sort of their reputation, but at least in their investment thesis. So one of the things that's very important is to understand that to get a term sheet, which, as we'll see a bit later, the first term sheet is the real goal of the entire fundraising. Well, so it's like the big step change in the entire fundraising process. You'll probably need to speak to 30 or 40 funds. And if you're in a market that isn't a very mature market, so typically if you're in a European country, you can't just afford to speak to your local as a national fund. You need to be speaking to more or less every single European fund if you want to get enough meetings to get that first term sheet. And so your list of targets ends up being a mix of sort of specialists that are looking at your industry regardless of where the company is based, and local funds that are generalists. The second thing that you need to have in mind when you're building that list is the behavior of some of these funds. So there's a difference between people who lead rounds and people who follow on rounds. Often when you're going to be pitching to investors, for a lot of investors, you'll hear, okay, I'm interested in your round, but only if you find a lead. And usually it actually comes with more strings attached to that. It's not just only if you find a lead, it's only if you find a lead of a quality I deem sufficient. And what they mean by a lead is somebody who usually will take up more than half of the round. So if you're raising 2 million euros, they'll invest at least 1 million euro, 1 million euros. And just as importantly, is somebody who will set the price for the round. And so often they'll say, okay, I'm happy to invest 250,000 euros, but the price is actually set by somebody else. And so if you manage to go and convince somebody to take the majority of the round, they say, okay, I'll follow. Even though some people will tell you early on that they'd rather follow than lead or whatever, you should always give the exact same amount of importance for a very simple reason, which is that even if it's follow-on money, this still builds to your momentum. If you're fundraising in the same way that every time you go speak to potential lead investors, you tell them angels A, B, and C invested, if you tell them we were at 300K out of our 2 million euro round committed last week, and now we're at 800K that's committed because we have a follow investor which is happy to put 500K, then the amount of uncertainty as to whether the round will be completed for the investor has gone down significantly, because usually, up until then you had 1.7 million euros left to fill, and now you only have 1.2 million euros. And so they got some outside proof that there was interest in your company and that the round was starting to gain momentum. And so it's very important that you don't have this sort of split process. Usually you need a leader or a leader to complete the round, but it doesn't mean that you should sort of give subpar treatment to people who aren't. A very quick brief on cold emails versus warm intros. So obviously, to the extent possible, it's much better to get warm intros. I think the best funds don't end up treating them very, very differently. So what often happens is that the highest introduction that you can get is from another founder. So if typically it's a lot of the companies that we prefer were introduced to us by other founders, but I'd say that the sort of two extremes are either introduced by other founders or came completely out of the blue and they just reached out and emailed us. And I think it's the same for most funds. If you listen to what they say, they'll probably say that a lot of their best investments came from cold emails or from introductions from other founders. So if you don't know anyone in the fund, it's definitely worth cold emailing them and getting sort of like lukewarm introductions by asking somebody who you don't actually know to just send the email doesn't actually add that much value. So I probably wouldn't spend too much time doing that. Another thing has to do with, so this I think Balthazar touched upon quite a bit, but I just wanted to reemphasize it pretty quickly. Has to do with the fact that the fact that it's a process doesn't mean that it's formal. A lot of people think that there's some sort of hierarchical relationship between founders and VCs, but at the end of the day, it's a form of partnership. And so you want to be treating them as equals. And so you want to be driving the conversation as much as they do, and you don't want to be spending the entire time pitching yourself, right? You want to be able to ask questions to them, not just about the way they think about, sort of not just about their firm, but also about the way that they think about your business. If you think about it, you're going to be spending, there's two reasons that it's important. The first one is that you're going to be speaking to 30, 40, 50 funds, and at the end of the day, you're only going to get money from one or two of them. And so you're going to get 49 or 48 conversations that don't yield any form of money. And so they don't yield money, it might as well make something of it. And so if you have the opportunity to learn, you definitely should take that opportunity. And the second is actually related to that. It's that one of the things that early stage founders are looking for is this founder resourceful in the sense of, is he able to do quite a lot with not much? And one of the things that not much is sort of VC's time. So if you don't get any money from them, but you can learn things about your markets, go-to-market strategy, if you can get fundraising tips from them, whatever you may extract out of the meeting that isn't money will signal to the VC that you know how to make the most of every single every single opportunity, which is a great skill and one that they always look for in founders. And two quick last points before we move on to questions. One mistake that founders often make is that they think that fundraising is something you unlock if you reach certain levels. So we'll often get questions like, what level of monthly recurring revenue do I need to reach before I can raise 1 million euros? And so it's a bit frustrating for us because, we'd like to say, oh, this company that was doing 25,000 euros in monthly recurring revenue, raised 1 million, so you should be able to do the same thing. But we're in a business of we're in an anecdotal business, right? So it's like there's no benchmark that will allow you to unlock fundraising. What matters the most is that you have a compelling story. And so the compelling story is showing what you've done to date with the resources that you've had, and showing what you're going to be able to do in the future. So both in the short-term future with the round of fundraising that you're raising now, and in the long-term future once the model continues growing. And so what's important to have in mind is that what you should be working on is crafting an incredible story that shows both that you have a big vision for the business that you're building and a very hands-on approach and deep understanding of your business and the particularities of your business, but at the same time sort of forget this idea that if you reach certain very concrete milestones, it'll be very easy to fundraise. It's not like school in that regard. And then last one about the first couple meetings and reaching out has to do with just the dynamics of the round. One thing that's very underappreciated for founders, because it doesn't seem sort of rational for people who are saying that they invest in people and blah blah blah, is that what actually drives the round is the uncertainty as to who else is looking at the deal. So sometimes it's almost a caricature, but a European fund will invest in a company just because they have the impression that one of the best American funds is looking at the deal, so not even necessarily considering investing, just spending some time with the founders, even though they haven't expressed yet an interest in investing. And the rationale behind that is just that, and we'll get to it in the next presentation when we talk about negotiation and momentum, is that at the end of the day, there's a big asymmetry between what you as the leader of the business and the investor knows. And so every minute that goes by where they can get more information is a minute that they won't. So until they feel that there's a lot of pressure and that the deal is going to be done imminently, and that if they don't send a term sheet now, they lose the deal, they probably won't. And so when we do the momentum, when we do the sort of short workshop on momentum in a couple minutes, I'll get into details about why that first term sheet is what matters the most. But what you need to be able to do when you're giving this first talk and this first presentation about your business to the investor is that you need to convey the fact that, and by convey, I don't mean explicitly state, but I mean sort of make them understand that you're having conversations with a lot of very good funds and that momentum is very much on your side. Because if you manage to give that impression and to project that confidence, then you'll be in a great position to get them to work and to get them to send you a term sheet fairly quickly. That being said, one of the very tempting things one of the things that sort of often tempts founders is to give false information as to the momentum of their round. And there are several reasons why that's not good. The first one is just that being honest is important, but the second one is that, in particular, when you're dealing with early stage funding, there are so few firms and so few investors that everybody sort of talks. And so if you tell them I'm speaking to X, but you're actually not speaking to X, or X has already passed on you as an investment, then the investor you told that to will likely learn it very quickly, and it'll shine a very negative light on you. It's for the same reason that you should be very straightforward with the figures that you give. So if you're talking about the sort of customers that you're signing, or the revenue you're at, or the sort of with other investors, you should always give the same numbers, because if you don't, they'll learn about it and it will always put you in a bad position. So before we move on to the next one, do you guys have any questions?
Perfect, Matthias. There are a lot of questions, but Balthazar has been answering a lot. So if you want to ask questions, feel free now, my friends. There is one about the family from Akshay. Does the family only help the startups to get the investment, or in every step to grow and become a giant?
So that's a great question. Honestly, so fundraising is the one that we're talking about now. for a variety of reasons, one of which is that we're changing the model a bit with something that's geared towards demo day. So that's one thing I didn't mention, actually. There are several ways that you can get introductions to angel investors and funds. So one is just reaching out to random people on LinkedIn, or looking at seed investors and going through their portfolio and getting introductions to, or just reaching out to the founders in their portfolio. Or the other one typically is to join a program like ours. And so one of the things that we do is that we organize this demo day where we have between 500 and 1,000 angel investors and about 200 or 300 VCs who come and look at the companies that we're working with. And so that's one of the things that we do. But to get companies to a stage at which they're able to raise money from institutional investors, we have to do quite a lot of things. So if you want, or if you will, investment is sort of like a derivative of having a good business. And so what we're mostly focused on is helping you have a good business. And so that means helping you think about who you should be hiring and sort of in what order, what your go-to-market strategy should be. We help you think about product and pricing, essentially whatever the things are that are big decisions in your business is where we're here to help. And fundraising is just one of those things. And it happens to be the most visible one. And that's when our name gets mentioned. And that's when there's a lot more paperwork, but it's not necessarily the funnest or the most interesting either for us or for the founders, to be honest.
Mihai is asking, what do you think of the entrepreneur bringing their own term sheet to the investor?
I don't think that's super common, to be completely honest. And I'd say that on average, it doesn't really work. It's true. I mean, it's true that for a lot of the best deals, VCs are very much doing a sales job. So they're trying to say what they're selling is money. And if they're giving you as much money as somebody else, you know, the fact that you prefer their smile to the other guy's smile is probably the only thing that, you know, they can really compete on. But if you just come with a term sheet, if you think about it, like 90% of the seed deals that get done only have one term sheet. And so if you just come with a term sheet, I'm guessing that in most cases, the investors will just laugh and say, okay, well, you can keep the term sheet.
All right. How to negotiate the perfect term sheet for a fundraising? Are there any strategies? I think that's your presentation, actually.
So we're going to talk about it right after. But the short answer is that if you're able, I mean, whether or not you're able to negotiate is a very simple function of the leverage that you have. And so if you have only one term sheet, you have not much leverage at all, right? So the leverage that you have is that if the founder wants to do the deal, if the investor wants to do the deal to the point that they'll pay any price, then you have some leverage, but that's rarely the case if you don't have an alternative solution to raising the funds. And then we'll talk a bit about the things that you can do and whether or not you should do them when you have more than one term sheet.
All right. Thank you, Yassine, for your question. It's an exceptional transition to the last part on term sheets, right?
Okay.
Are you ready?
Que la famille.